If you own gold or silver, you're thinking about buying either one. What happens in the next few minutes at the Federal Reserve is going to matter more to your wealth than almost anything else happening in the news right now. Not because of a rumor, not because of some hidden signal only insiders understand, but because of something far more powerful and far more predictable. The mechanics of debt, interest rates, and confidence playing out exactly the way they have for centuries. Stick with me, because by the end of this video, you are going to understand something that most investors never take the time to learn. And that understanding alone could change how you protect your savings for the rest of your life. Before we go further, I want to know something. Comment below where you're watching from and tell me honestly, are you currently holding gold, silver, or mostly cash? I ask because your answer says a lot about how you're feeling right now. And feeling, as we'll discuss later, plays a bigger role in investing than most people are willing to admit. Let's start with the foundation, because to understand why gold and silver behave the way they do, you first need to understand what a central bank actually is and what it's trying to do every single day. The Federal Reserve is not a mystical institution making arbitrary decisions in a dark room. It is at its core a manager of confidence. Its primary tool is the interest rate, the price of borrowing money. When the Fed raises interest rates, it makes borrowing more expensive, which slows down spending, cools inflation, and strengthens the perceived value of the dollar. When the Fed lowers interest rates, it does the opposite. It makes borrowing cheaper, encourages spending and investment, and in the process, it quietly reduces the value of money sitting still. The single lever up or down ripples through every market on earth, and it is the primary reason gold and silver rise and fall the way they do. Here's the part most people miss. Gold and silver do not really go up in the way people describe it. What actually happens more often than not is that the value of paper currency goes down relative to a fixed finite resource. Gold has been used as a store of value for over 5,000 years, not because it does anything useful in a factory, but because it cannot be printed, diluted, or created out of thin air by a policy decision. When central banks expand the money supply, which happens through lowering rates or through more direct measures like quantitative easing, the number of dollars in existence increases while the number of gold ounces in the world stays essentially the same. That mismatch over time is what drives the price of gold higher. It isn't magic. It's supply and demand playing out on a monetary level instead of a retail one. Now, here's where it gets interesting, because right now the Federal Reserve finds itself in one of the most difficult positions it has faced in decades. On one hand, inflation, even after cooling from its post-pandemic highs, remains a persistent concern embedded not just in headline numbers, but in wages, services, insurance, and housing costs that don't easily reverse. On the other hand, the United States government carries a debt load that is now measured in the tens of trillions of dollars. And every increase in interest rates makes the cost of servicing that debt dramatically more expensive. Think about it like a household that has taken on a massive mortgage. If interest rates rise, the mortgage payment rises with it. Multiply that dynamic by the scale of an entire national government, and you start to see the bind the Fed is in. Keep rates high, and the government's own interest payments balloon to unsustainable levels. Cut rates too soon, and inflation could reignite, eroding the value of the currency people rely on to buy groceries, pay rent, and plan for retirement. This tension between fighting inflation and managing debt is not new. It has a name among economists, a debt cycle. And history has shown us this movie before. In the late 1970s, the United States faced double-digit inflation alongside a fragile economy, a condition economists called stagflation. The Fed under Chairman Paul Volcker made the extraordinarily painful decision to raise interest rates aggressively, even though it triggered a recession, because the alternative, allowing inflation to spiral unchecked, was considered worse for the long-term health of the currency. Gold during that decade rose from around $35 an ounce to over $800 an ounce at its peak, an almost unthinkable move driven entirely by the public's loss of confidence in the dollar's ability to hold its value. Silver moved even more dramatically in percentage terms during the same period. That historical episode isn't a prediction of what will happen now. No serious analyst claims history repeats exactly, but it is a powerful illustration of how monetary stress translates into demand for hard assets when trust in paper currency weakens. Let's talk about bonds for a moment, because bonds are the quiet machinery behind almost everything we're discussing. A government bond is essentially an IOU. The government borrows money from investors and promises to pay it back with interest. When investors trust that a currency will hold its value, they're happy to lend money at low interest rates because they know the money they get back will still be worth something. But when doubts creep in, doubts about inflation, doubts about a government's ability to manage its debt responsibly, investors demand higher interest rates to compensate for that risk. This is why you'll often hear analysts talk about bond yields rising as a warning sign. It isn't a technical curiosity for Wall Street professionals. It's the market's way of saying we need to be paid more to trust you with our money. And when that trust iridesces enough, capital naturally begins rotating toward assets that don't rely on anyone's promise to pay. Assets like gold and silver, which have intrinsic scarcity built into their very existence, rather than a government's word behind them. Now, here's something that has been happening quietly away from most headlines, but which tells us a great deal about where the world's largest financial institutions believe things are heading. Central banks around the world, not retail investors, not hedge funds, but the actual central banks of nations have been accumulating gold at a pace not seen in decades. Countries like China, Russia, India, and several others have significantly increased their gold reserves over the past several years. This is publicly reported data tracked by organizations like the World Gold Council, and it reflects a broader trend of central banks diversifying away from an overreliance on the US dollar as their primary reserve asset. Why would central banks of all institutions want to hold more gold? Because they understand something on an institutional level that many individual investors overlook. Currencies can be devalued through policy decisions, but gold's value is anchored in something no single government controls. When the very institutions that manage money are quietly buying more of the one asset that isn't anyone's liability, it's worth paying attention to what that behavior implies. This connects directly to the strength or weakness of the US dollar itself, which brings another layer into our picture. The dollar strength isn't just a number on a screen, it's a reflection of global confidence in America's economic and political stability relative to the rest of the world. When the dollar strengthens, it becomes more expensive for other countries to buy dollar-denominated commodities, including gold, which can temporarily suppress prices. When the dollar weakens, the opposite happens. Gold priced in dollars becomes relatively cheaper for the rest of the world, often pushing demand and prices higher. This is why gold and the dollar tend to have an inverse relationship over long stretches of time, though certainly not in perfect lockstep, especially during periods of acute global stress when both can rise simultaneously as investors seek safety wherever they can find it. And speaking of global stress, we cannot discuss gold and silver without acknowledging the geopolitical backdrop that has defined much of the past several years. Trade tensions between major economic powers, ongoing regional conflicts, sanctions regimes that have frozen foreign reserves for entire nations, and a broader trend of countries seeking to reduce their dependence on any single global currency system. All of these factors add a layer of uncertainty that historically drives capital towards safe haven assets. Gold in particular has functioned as a form of geopolitical insurance for centuries, precisely because it has no counterparty risk. It doesn't depend on a government continuing to exist, a bank remaining solvent, or a political relationship staying friendly. When trust between nations, phrase individuals and institutions alike tend to rediscover why gold has held its monetary role for as long as recorded history. Let me pause here and tell you about someone I'll call Richard. Richard was 61 years old, 3 years from retirement, working in logistics management, someone who had spent decades quietly building a diversified portfolio of stocks and bonds, exactly as most financial advisors recommend. In the early 2000s, after watching the dot crash wipe out a significant portion of his colleagues' retirement accounts, Richard began allocating a modest percentage of his portfolio, around 10%, into physical gold, not as a bet for massive gains, but as what he called financial insurance. For years, friends teased him about it, especially during the stock market's strong runs through the 2010 seconds when gold seemed to underperform by comparison. But Richard held steady, treating that 10% as untouchable, a piece of his portfolio designed specifically for the moments when everything else went wrong. When the 2008 financial crisis hit, and again during the market turmoil of 2020, while much of his equity portfolio suffered sharp temporary declines, his gold allocation held its value and in both cases appreciated, cushioning the overall blow to his retirement savings. Richard's story isn't about getting rich from gold. It's about what financial insurance is supposed to do. Sit quietly in the background seemingly unnecessary until the one moment it matters most. Contrast that with someone I'll call Melissa, a 34-year-old marketing professional who, during a period of intense media coverage around inflation fears, decided almost overnight to convert nearly her entire savings account into physical silver, driven largely by fear-based headlines and social media hype rather than a considered strategy. She bought near a short-term price peak without any plan for how much of her portfolio precious metals should reasonably represent given her age, her time horizon, or her other financial goals. When prices pulled back in the months that followed, as commodity prices often do after sharp speculative rallies, Melissa panicked and sold at a loss, feeling betrayed by an asset that in reality had simply behaved the way volatile commodities always have. Her mistake wasn't choosing silver. Her mistake was letting emotion dictate both the size and the timing of her decision, treating a long-term store of value like a short-term trade. These two stories bring us to something just as important as any economic data point we've discussed: the psychology of investing itself, and specifically the biology behind it. When markets become volatile or when frightening headlines about the economy dominate the news, our brains respond in a very real, very physical way. The amygdala, a small almond-shaped structure deep in the brain, is responsible for processing fear. And it can trigger a stress response, elevated cortisol, a racing heart, an urge to act immediately, often before our more rational prefrontal cortex has a chance to properly evaluate the situation. This is precisely why so many investors buy at the top, driven by a fear of missing out, flooding the brain with dopamine during a rally, and then sell at the bottom, driven by a genuine physiological fear response during a downturn. Understanding this isn't just interesting trivia, it's a practical tool. Simply recognizing that your urge to make a dramatic financial decision during a moment of high emotion is in part a biological reflex rather than a purely rational judgment can help you pause, breathe, and separate the signal from the noise. Now, before we get to the piece that ties everything we've discussed together, I want to ask you for something small. If you found this breakdown valuable so far, take a moment to like this video and subscribe to the channel, because what we're about to cover in the next few minutes is the part that makes sense of everything we've discussed up to now. The Fed's dilemma, the debt cycle, central bank buying, currency dynamics, and the psychology of fear and greed. Stay until the end, because the final insight is where all of these threads come together into a single coherent picture. Let's return to where we started, the position the Federal Reserve currently finds itself in. Historically, when a central bank faces a choice between protecting the value of its currency through higher rates or protecting the government's ability to finance its debt through lower rates, the pattern that is repeated across nations and across centuries tends to favor eventually prioritizing the ability to service debt. This isn't a conspiracy theory. It's a structural reality that economists have documented across dozens of historical examples, from ancient Rome to basing its currency to fund military spending, to numerous 20th century examples of governments choosing inflation over default when debt burdens became unmanageable. This doesn't mean hyperinflation is coming, and it doesn't mean the dollar is about to collapse. Responsible analysis requires resisting that kind of dramatic, fear-based framing. What it does mean is that the incentive structure facing policymakers when debt levels are this elevated tends to favor a gradual erosion of currency purchasing power over time, rather than the alternative of aggressive sustained monetary tightening that could risk a broader economic crisis. This is precisely the environment in which gold and silver have historically played their most important role, not as speculative trades designed to make someone rich overnight, but as a form of wealth preservation, a hedge against the slow, often invisible erosion of purchasing power that happens when currency expansion outpaces the growth of real economic output. Silver adds an additional dimension to this story because, unlike gold, silver has substantial industrial demand used in solar panels, electronics, and a growing range of green energy technologies, meaning its price is influenced both by its monetary role as a store of value and by genuine growing industrial consumption. This dual nature can make silver more volatile than gold in the short term, but it also means that structural demand from industries like renewable energy adds a layer of support that didn't exist to the same degree several decades ago. Let me share one more story because I think it captures the balance we're really talking about. Consider someone I'll call James, a 48-year-old small business owner who, after watching both Richard's steady approach and Melissa's emotional mistake play out among people he knew personally, decided to take a measured, educated approach of his own. Rather than going all in on precious metals or ignoring them entirely, James spent several months researching historical precedent, reading about the relationship between debt cycles and currency values, and eventually settled on allocating around 15% of his overall savings into a combination of physical gold and silver, treating it as a long-term hedge rather than a short-term trade. He set that allocation, largely left it alone, and continued focusing the majority of his energy and capital on growing his business and his other investments. Years later, when broader market uncertainty caused significant swings in stocks, his precious metals allocation provided a stabilizing counterweight. Not because he had timed some dramatic prediction correctly, but because he had structured his decision around discipline and historical understanding rather than emotion. So here is the final insight. And I promised you the one that ties every thread we've discussed into a single conclusion. This isn't about a secret the Fed is hiding or some hidden signal only a select few understand. It's simpler and honestly more powerful than that. When a government carries debt at the scale we're seeing today, and a central bank must balance the competing pressures of controlling inflation while keeping the cost of that debt manageable, the historical pattern strongly suggests that currency purchasing power tends to erode gradually over time, even during periods when inflation appears to be under control. On the surface, gold and silver have functioned across thousands of years and dozens of different currency systems as one of the few reliable ways to preserve purchasing power against exactly this kind of gradual erosion. This is not a certainty, and no responsible analyst should present it as one. Economies are complex, policy can shift, and unexpected events can alter trajectories that seem obvious in hindsight. But understanding this dynamic gives you something invaluable: the ability to make decisions about your own wealth based on structural reasoning and historical evidence rather than reacting emotionally to whatever headline happens to dominate the news cycle this week. If there's one thing I want you to take from everything we've discussed, it's this: the investors who tend to do well over the long run, whether in gold, silver, stocks, or any other asset, are rarely the ones chasing the most exciting headline or the most dramatic prediction. They're the ones who take the time to understand the underlying mechanics of the system they're operating in, who build a plan based on their own goals and risk tolerance, and who have the discipline to stick with that plan even when fear and greed are pulling at them in opposite directions. Richard didn't get rich from his gold allocation. James didn't make a dramatic headline-worthy trade, but both of them protected what they had worked hard to build by treating precious metals as one part of a thoughtful long-term strategy rather than a reaction to fear. We are living through a genuinely complex and historically significant moment in monetary policy, and it deserves to be understood with clarity rather than approached with panic. Whatever decisions you make about your own portfolio, make them based on evidence, on historical context, and on a clear understanding of your own financial goals, not on the emotional whiplash of headlines designed to grab your attention for 30 seconds. Stay informed, stay curious, and above all, stay patient. Wealth built on understanding tends to last far longer than wealth chased through fear. And if this video helped bring some clarity to a topic that so often gets buried in noise and hype, share it with someone who needs to hear it calmly explained. And I'll see you in the